In this week's update, top forming or buyers still in control, process to buy rebounds early, and the scope of the energy crisis starts to be priced in. My name is Gary Davis. I'm an authorised representative of Primary Securities, and the information in this video is of a general nature only. Since even before the war started, investors have had to deal with just an extraordinary mixture of different issues. We've had extreme, sustained volatility through the Trump tariffs and all of the ups and downs of living with a president like Donald Trump. We've had a correction, we've had forced selling, we've had huge uncertainty around energy and fuel security. We've got increasing pressure on the Australian economy in many ways. And then, as always, when the news is just seeming to be getting to its extreme worst, we start to see some very strong rebounds. So today I want to apply what I've been talking about now for months and to put the beginning of a potential top, and I stress potential only, into the proper perspective. So why I said bounces were coming just a few weeks after the war started, the process we use to raise cash to buy the rebounds early, because you've got to be positioned. You can't take advantage of these rebounds if you don't have any cash. And which are the mega trends that we're looking at that could be the next ones to move on? So there's a very repeatable process here, as I stress every week. If you don't have a repeatable, almost cookie cutter kind of process, these markets will just eat you alive. They're very difficult. And it's not always easy emotionally to deal with them, but the process itself is actually very simple. You've just got to be prepared to shut out the noise and observe what the market is really doing. But look, today's focus is on why it was so obviously clear to me and pretty simple. There's nothing magical going on here. I don't have any particular power to predict these things because I don't predict. It's human nature playing out. If you understand that, it's really quite simple. So the process of navigating really difficult markets is you want to forecast less, just don't bother thinking about it. It's pointless. And you want to just put more into preparation. Prepare for the what ifs. What if a good outcome happened? What if a poor outcome happened? We build cash. We get our targets list ready before the emotion peaks, because once the emotion peaks, it's really quite hard to pull the trigger on the things that you need to pull the trigger on. So you need to have that target list and the cash ready in advance. And don't let headlines set your plan. That is completely putting the cart before the horse. A really important thing, and I've been talking about this to the exclusion of anything else for 5 or 10 years, you just got to deal with the areas of the market that are going to have the highest probability of strong long-term gains. And another word to use is megatrends. And you find them because they are structural, meaning that they're very long-term, long-lasting. The impact is not going to go away in 6 months or 12 months. It's going to last for a decade or more. It's going to lead to the best stocks having really quality earnings growth, earnings strength, and just narrow your field of view to that. Avoid the shocks that can't be researched or controlled. We can't do anything about the stuff that we can't control, so don't worry about it. The good news is most of the things that we can control are the things that really make the difference, and they are in the majority. So don't worry about the things that you can't control. Just use a bit of good old risk management. And then, of course, let the market confirm. Don't try and guess this in advance and thinking that you can be really smart and tell people about how you picked within 5 minutes of the bottom, because price action leads the news, and most people are led by the news. That's the natural conclusion. The news is bad. The outcome should be bad. That's the normal conclusion. But it's just not how markets work. Markets are pricing in what they perceive as the future in 6 months' time, 12 months' time. So price action has to lead the news, because that's how markets work. They are constantly trying to price in the unknown. And charts are the window to where the money's flowing, and they tell us when to move. And so that needs to be your primary signal. So the reality is that bottoms tend to form in Bad news, the majority, because of human nature, will feel the most fearful near the bottom. And that, of course, means that you're needing to pull the trigger when the fear is the highest, the most difficult time to do it. So this is not easy, but it is very straightforward. And if you want to wait for certainty, well, that's fine, but it means that you're going to be paying a lot more, and you would have virtually completely lost your edge. Once the market gets back to a point where we all relax and we feel certain, then all the advantage is gone. If you want to wait for that, fine, but just expect mediocre returns. That's the price you've got to pay for certainty. And we want to use strategic cash offensively. We don't just raise cash because we're panicking. We're raising cash which is earmarked for the targets that we already have in mind. And the best targets are megatrends that have corrected. They've been in really strong uptrend. They've had terrific momentum. They've probably got a bit overvalued, and so they correct. Perfectly normal. That's when you need to buy them. So it's attack capital for quality assets. That's what it's about. Buy progressively as sellers lose control of the market and the buyers start to get that back in again. Keep the rules simple. You need to be clear about your purpose. Why do you own that particular stock or entity, ETF, commodity, whatever it is, and the position size and your exit rules. Now, for those of you that don't do this and you've been an investor on your own over the years, this might all seem like it's just all too much. And why can't I just do it as it comes? And the answer is, you'll probably get a lousy result. That's the bottom line. We observe, we respond according to a plan, and we stay disciplined. That's it. Now, I just want to go through some of the slides because I've been talking about this particularly since the war started. So I just want to go through some of the slides and the themes that have been in these videos since the first weekend of March. And a number of people told me loud and clear that I was absolutely stark raving crazy. Some of the things that I said in this particular Sunday video on the 22nd of March. And the message then was that panic selling was everything. Quality was becoming too cheap, and so therefore there was opportunity. But the bottom still needed confirmation. So that's 3 weeks after the war started. Now, some of the comment we got was pretty severe, I must say. I hardly do anything on social media at all, so I'm not used to that kind of severity, but there was some rather nasty people out there. And there were some that we actually put in the comments section under the video, but some that we couldn't even put there. They were so colourful. It just reinforced what I've learned over the years. The herd will react in a very predictable way. So what actually ended up happening after that? Well, we saw rebounds in gold, silver, and our copper, and we just saw an absolute explosion in AI and tech, not so much software, but certainly in AI. And I'll just show you a couple of charts very briefly. So this is an ETF listed in Australia, and it reflects AI and tech. And here's the rebound, massive rebound in this particular sector. And if you look on individual, so this is just a general ETF. If you look at some of the individual US stocks, I mean, doubles and triples within that period are plentiful. So an amazing rebound in AI and tech. This is one of the US copper stocks that rebounded really, really strongly, almost a double there as well. So that was the outcome, and the lesson is prepare before the event, because if you didn't have those AI stocks in mind, if you didn't have those copper stocks in mind before the event, then you would not have known what to jump on. On the 12th of April, the message then, the news was terrible, but prices were improving. That's a head scratcher. And professionals continued to buy the panic. They just hoovered up everything that was being tossed out in a panic. And that we should be accumulating when the money flows are shifting, as they were. What happened after that? The market pivot became very clear, and the professional buying kept supporting the rebound, and the rebound went a lot further than the vast majority expected it would. So the lesson from there, the market turns before it feels safe. That's the message. On April 27, to do with money flows, the message then was the rally was backed by the money flow. Semiconductors, and particularly US tech, far more so than Australian tech, confirmed the breadth of what was happening. There were just so many US stocks that were just ripping to the upside. Earnings and guidance have supported most of the valuations. The US, there's a few. There's always a few, but it's a low percentage. The US market does not have a valuation problem, not in the mega trend areas that I look at. The growth is just so strong that it well and truly justifies the earnings. Do not swallow this stuff about with so many standard deviations above the long-term average. You just can't look at the market that way. It is too diverse. What happened after that? Well, the money flows just kept confirming the rally, and all the naysayers were just wrong again. And US tech and semiconductors kept heading higher. So the lesson is watch the money flows, not the news. And this is the consistent message that I've been putting out now just about every Sunday for, 18 years in total, but certainly since things have become really volatile since COVID. Now, the rebound has not been random. Gold and silver stocks moved first. Then we saw copper join in, and copper had a tremendous couple of days to start last week. And of course, we've seen the confirmation with AI tech and semiconductors being well and truly supported by earnings. So what matters from here? Well, it's the stocks that have got earnings power and the money flow, the free cash flows that allow them to do the investing that's required. That's what really matters from here. So fundamentals are important, but they're only important to the extent of getting you in the right fishing hole, and you've heard me say that before. So over the next week or two, I'll be covering which of the mega trends are next. If you watch the charts closely, it's pretty obvious what actually happened. All right, I just want to touch briefly on the advantage that members of specialist education have received throughout this whole period and why they feel so relatively calm and confident about what they're doing. And this will be very quick. So they receive a daily perspective, and that's just so critical because it's not tied to anything. It doesn't have any agenda, but it just helps members keep their head straight because it's so difficult in these kind of markets to keep your head straight. And importantly, it's not anchored to yesterday's view. You know, what people were talking about a month ago. It's purely focused on being up to date with what the market is telling us so that we can all gain the best possible outcome. That's what we're after. It's a clear process, has to be. You can't survive in these kind of markets without a framework. And that clear process, you've heard me ad nauseum refer to every week because I think that's what refreshing perspective is about. It's about megatrends. It's about quality stocks that get you in the right fishing hole. And then it's about money flows to determine when you get in, when you take profit, when you take exits, all those sort of things. So you've got to have your entry and exit plan. The result is that we continue to pursue a high growth approach, but we manage risk very, very diligently. That's what we're about. And if you're interested, the results are visible on the website over the last 3.5 years in the Insiders Club is there, visible on the website. And it's a pretty impressive track record. So we aim to exceed the crowd, and that's not terribly difficult. As a consequence, we're providing a short-term offer, a very short-term offer, $149 a month for the first 2 months, and after that, it's $249 a month if you think it's for you, what we do, and a lot of people do. There is no lock-in if you do the first month and you don't want to do the second month. Come and join us. We're doing well. But if what we do is not your style, then fine. Now, this will be available through the next week. What is included, entry and exit recommendations, daily perspective videos, a phone onboarding process to help you sort out your plan and your perspective, and a lot of email support. So the real value is that you get a plan that you create. This is not a generic plan. This is what is most suitable for you. And all I do is pose the simple questions that I think most people, they really don't know what the questions are. And that's fine. That's not a criticism at all, because if you don't do what I do, which is coaching for several decades, then you don't know the questions to ask. There's a lot of execution support, and tips are a complete waste of time. Tips on their own that aren't according to a plan and that don't give you exits are just a waste of time. They really are. And of course, always we strongly advise that you obtain all your own investment and financial and legal and all the other advice that you need, because it's a difficult market. And the narrative has been changing in some cases almost hour by hour. You know, the war changes, the oil narrative changes, the inflation narrative changes, and that's going to continue. The AI and technology narrative keeps changing just dramatically. Every week there is some incredibly huge announcement on one part of that or another. And if you're trying to interpret all that on your own while trying to manage your emotional response, it's just so really, really difficult. And there's really nothing mystical about navigating these periods. When you look back, it'll define so much of your long-term investing return. It's hard to do because the market is most uncomfortable at exactly the points where the best opportunities tend to appear. And I think intuitively, a lot of people kind of know that, but they just don't know the steps to tap into it. So members have a clear framework and a plan. We've been looking for stocks that are supported by genuine long-term megatrends. It's where the earnings potential is strong. And that's just the basis of everything that we do. The important thing is that we're not right every time. That's impossible. The important point, and I've spoken about this again many, many times, is that winners are allowed to become meaningful, and that you will make the majority of your success over the years and the decades by letting those really, really good winners unfold, and conversely contain the losers. So the portfolio is always seeking to do that, having a process that allows you to stay on board that, but also a process that will get you out, because you've got to have a lot of tries at this. You'll have a lot of false starts. So the key is to know how to get out of the false starts quickly so that you contain the losses, but then being able to recognize the ones that are really going to have the potential to pay off and stay with those. And this is the difference between reacting emotionally to what the market offers and having a structure that tells you what to do next. Okay, now let's look at the commodity space. But before I go there was a huge turnaround in the Australian market on Friday afternoon and then the US market on Friday night. And it was the market, particularly the commodities part of the market, got absolutely slammed. And everyone was scratching their head and saying, well, wow, where did that come from? So this will give you some insight. I'm not saying that it's the whole explanation, because there's a lot of working parts when this sort of thing happens, but I think this will give you a reasonable idea, and then, maybe just calm some of the fears that you might have, some of the unknowns. So late in the week, we saw bond yields rising. So that was one trigger, and they started to rise quite quickly. We saw the Japanese 30-year bond rise above 4% for the first time in nearly 30 years. That is significant. That is really significant. We saw the US 10-year yield rising very strongly to 4.6. Let me just zero out. There's the US 10-year over the last 12 months. So you can see just how rapidly it moved from 4.3 to 4.6. And that's a big move. Mightn't be with a stock, but it's a big move in the bond market or the currency market. And this is what it looks like over the last 5 years. So we're now basically pushing the all-time highs that we've seen over the last 5 years. And if we go and look at the last 10 years, then you can see again it's the same. So there's been a very, very strong move in the bond market. That's all you need to understand. And It's a big deal. That's the message. Forget all the numbers. What is happening in the bond market is a big deal. The second thing is that the crude physical supply disruption is now becoming clearer. And I've been talking about this since pretty much a week or so after the war started, once we had a bit of a handle on the severity of this. But it never seemed to me to be realised by the market that countries, or acknowledged by the market, that countries were dramatically drawing down their reserves of oil. And also the on-water supply was being drastically depleted because ships that were already on the water before the war started took a month to reach their destination and discharge. So that meant that there was a supply of crude oil to the refineries, particularly in Asia. And so it didn't appear as though there was going to be this massive impact. And if the war could be wrapped up quickly, then, life would go back to normal quite fast. But it always seemed to me that that was just too simplistic, because I could never understand how Iran would give up its position. It's holding the world by the throat. Why would they give up that position? So it never really made sense to me that the war would be over quickly. And therefore, this on-water supply depletion would run its course, and things could only get worse, and quite probably rapidly worse. So unless this war wraps up soon, then we're going to see things get a lot worse with the energy shock. And I think that is just starting to get recognised and starting to get priced in to all sorts of assets. Now, at some point, and I don't know what point that is, whether it's oil at 150 or 200 or what it is, but at some point there will be some demand destruction. In other words, the global activity will have to slow down because the price of oil will just be prohibitive. But oil is critical to so many things. So the only logical conclusion is that it all slows down. And I don't think that's been priced in. In fact, I know it hasn't been priced in, but it's starting to be now. So that is the reason that we saw such an abrupt reversal. We had silver breaking out, we'd seen copper break out, and then immediately reverse. So it was because of those two reasons above. So copper finished at 625, was flat, but it got up to 660 at one stage. Crude oil shot back up again from 95 to 105. I'll get to those charts in a minute. Let's just touch on precious metals. Gold fell 3.6% for the week to 45.48 in Australian dollars, 63.57. Silver lost 5.7%, but from the peak, it was down very sharply, the peak in the week. So 75.75. And with gold, we've got 43.80 as a lower boundary that I'm watching closely, and 48.90 as an upper boundary, and I had that last week. And I also said last week that the odds of a breakout before and into the war were not high. And I spent the first few days thinking, well, I'm wrong on that score because the war is still going, but we've got this huge breakout in silver. But look, it only lasted, 2 days, 3 days? So that's where we sat with precious metals. For me, the precious metals market and precious metals stocks, the end outcome remains unchanged. This is the opportunity of the decade, or one of the opportunities of the decade, along with AI, is gold and silver. So that end point remains absolutely unchanged. I'm totally confident of that. But what we're going to see is some severe volatility that is going to shake most investors. This is where your clarity of purpose and your time frame and suitable risk management for you becomes non-negotiable. It's not something you can avoid. If you try responding to most of these very abrupt reversals, thinking that they actually mean something in the longer term, then you're probably not going to survive this journey. It's that important that you get all your ducks lined up here, and most investors need someone to help them with that. So let's go and look at precious metals, and we'll also take a look at the other US charts as well. So let's just start quickly with the currencies. So there's DXY on a monthly chart, just to give you the bigger picture. So the biggest picture is that we've got overall a rising US dollar trend, but all the fundamentals are working against it. So it'll be interesting, very interesting to see how that one plays out. And that is what it looked like on a daily basis. So we've got a de-dollarization process, which is putting downward pressure on the US dollar. So that is the demand for US treasuries, US currency for trade. All the pressures are to the downside. So that should keep downward pressure on it. The upward pressure is coming from the fact that bond yields are rising. And so therefore, just from a purely, would you rather 5% or 4% perspective, is putting upward pressure on the US dollar. So we'll just have to see how that one resolves. The Australian dollar, of course, is going the opposite way, and that was quite abrupt on both Thursday and Friday, as you can see. Just quickly jump onto the US indices. That's the NASDAQ composite on a weekly chart. So we ended up about flat on the composite. There's gold versus the US dollar. I was kind of thinking that it would find support. So this is the ratio between gold and the S&P. But because the war hasn't ended, then we're obviously going to have a further excursion to the downside. But we are now in a field where the turn should be meaningful. I don't know where it is. I'm not even thinking about where it is. I'm just watching, observing with a response plan in mind. There's consumer discretionary versus staples. The market is starting to roll over again. The market is turning a little more defensive. Semiconductors were having another great week until the end when they finished down a little bit. But you can see that it's not dramatic. And if we look at Friday, so this is important. I've got a couple of charts to show on this. When you look at that is not that dramatic, is it? Didn't close on its lows, wasn't a big range candle. We don't have massive volume. So to me, whilst the numbers were up there, I think semiconductor index was down about 4% or something, but that doesn't look drastic to me. And I'll come back to that. This is the relative sectors of the US market. Technology is just roared through the ceiling. A massive week just until the final day, and energy rebounding. But everything else was turned to the downside. In the Australian market, energy is leading. Technology is not in the same ballpark as it is in America. And healthcare, of course, just getting absolutely murdered with CSL and Cochlear and ResMed and all those stocks. So that's how the two markets set up. They set up very, very differently. There's the S&P again on a weekly, so flat on the S&P. The energy sector, extremely positive for the week. There's the Russell, down about 3 or 4%. So there was certainly some selling in the smaller parts of the market. Now, the final thing that I want to go to is just to show you a couple of US charts, just to kind of reinforce that there was really nothing dramatic in the Friday reversal, even though you might read that there was. This is AMD. Now, just look at how extended this price was. The orange line is the 8-day moving average. The green line is the 20-day moving average. So if you go back a couple of days, this was way above the 8-day moving average. This was a really, really powerful trend, bordering parabolic. Yet look at Friday's response when the bond yields went up, the US dollar went up. That's a really, really tepid response. So I'm not getting overly concerned about what happened in the US on Friday night. Here's another one in the tech sector. It gapped down, yep, but no real exaggerated volume, and it actually closed higher than it opened. And at one stage, it was actually in the positive. And this is the big one for this week coming, and it could change the market in America quite dramatically, the sentiment. So they report on May 20. I think it's aftermarket, so we won't see the impacts until a couple of hours after the close of May 20. But this is NVIDIA. And if they shoot the lights out again, as is their habit, then that will swing the sentiment in the American market back again. And when I put that together with these kind of fairly tepid responses to the big bond yield rise, I'm a lot more relaxed about it once I had a chance to digest it and think about it than I expected it to be when I looked at the headlines. All right, so just wrapping things up, there's the spot copper chart. You can see the big spike to $6.60, and then we came back to $6.25, which is where we basically started the week. Crude oil, we dipped, and then we rebounded back to 105. So that covers all the charts. Been a long video, but gee whiz, there's so many really, really important things happening that members need to have a sharper perspective on. So the final message, after the budget on Tuesday, and I'm not going to talk in any depth at all about the budget, that's not the purpose of this video, but I will just make the comment that Australia now has a very different investing landscape, and the sooner that you embrace and start to think about what changes are appropriate for you, the better. I think there's a very real chance that what will happen here in Australia is that most investors will ignore the budget changes. The majority of the investing public will not really know how it affects them, and so they won't respond. They'll just have we'll see how it plays out kind of approach. And you'll wake up in a couple of years and you will find that you are so far behind where you could have been that it will dismay you. I think that is how things will unfold in the next few years. But look, this budget is, I was going to say outlandish. It's not. It's certainly out there in terms of what they're trying to do. And as a consequence, whether the idea behind the budget is good or not, there will be many unforeseen consequences. And I severely doubt we've seen the government's real long-term agenda. I think this is step one and there's still 9 steps to come. But the point I want to make, and this is what's important to investors, is that if you focus on tax planning, over the years, I've got questions from outside the membership about capital gains tax. And of course, I can't answer it because I'm not in a position to answer it and I'm not allowed to answer it. But I've just said to people, look, if you focus overly on and allow tax consequences to come into your thinking, investing's hard enough. Just leave it aside. Let your account unravel it. Focus on real growth investing, because if you focus unduly on tax planning, let me give you a couple of alternatives. Do you want to pay 15% tax on $500,000 worth of assets or income, or do you want to pay a much higher rate of tax, but on a far higher portfolio of assets? So I've just thrown some numbers in there, but take the concept. You can get overly focused on tax consequences and you can miss out on serious growth investing. And the end results are very, very different. So we've got new rules. We don't know the consequence of those new rules yet. They're not law yet. But I think you need to narrow your field of vision. And I come back to something that I say all the time. Just control what we can. There's no point in worrying about things that we can't control. Just do what we can. And it's a lot like Warren Buffett's egg basket approach. Own a modest number of stocks in the one basket, but watch those eggs very carefully. So in other words, do your research, stay on top of it, all those sort of things. So I think successful investors going forward are going to really narrow their field of vision and they're going to get better at what they do. So let me just finish this with a couple of obvious rhetorical questions. Will AI and the data center build out, will that change as a consequence of what's happened in the last week? And the answer, of course, is no. Will future robotics change? Absolutely not. That progress is unstoppable. Who are the overwhelming beneficiaries? Who are the direct beneficiaries and who are the second order beneficiaries? There's going to be a huge number of beneficiaries of AI and robotics. So the long-term endpoints have not changed. They've just become more taxing to live with the journey. And this is why you need an evolving perspective, a constantly refreshed perspective, and you need lots of support because you're being bombarded on one side by the media and all its stupidity. And on the other side, you've got a plan that you're trying to stick to. It's a real tussle. It's not easy. And that's why you need that perspective and you need a lot of support to just keep nudging you back onto the rails that you want to stay on. So that's it for this week. There's a lot in it. Some people might want to watch the second time, which I would encourage. There's the more information on our website. There's my email address, and I'll be back with you next Sunday. And I promise I'll make it a shorter video. Cheers.